Hi, this is Dan Collins, Editor-in-Chief of Futures Magazine, coming to you live from the floor of the Chicago Board of Trade on October 29th, 2014. Today is actually a historic day because the Fed is expected to end its quantitative easing 3 program by by completing tapering of that program and stop buying government bonds. This is a process that started in December. It started late because of the late 2013 economic downturn that pushed off tapering for a while. For a slight time in this month, the idea of extending this out a month or a meeting was possible because of the 10% correction in the S&Ps. But I think the S&Ps are actually flat for the month of October, so a lot of that panic has subsided, and the Fed is expected to end the bond purchasing program. But the one controversy that people are looking at is, will the Fed continue with the language of keeping interest rates extremely low for an extended period of time? I think it's kind of a false argument because in her first press conference, Fed Chair Janet Yellen surprised some people when she said they could begin tightening as soon as 6 months after the end of QE3. Well, that surprised some folks, but it really set a bottom floor. Most people thought that tightening would begin mid-2015, and that's the upper range of that. So with the economic downturn, a lot of people thought tightening would begin at the end of 2015 or even out to 2016. But that doesn't affect the language because the language can cover 6 months. So I really think that's a non-issue whether that language is in the Fed statement today or isn't the Fed statement today. The one thing that's interesting is when the market took a downturn earlier this month, the Fed funds rate spiked up, and it looked like instead of looking at mid-second quarter to third quarter for the beginning of tightening, the Fed funds indicated it wouldn't happen until the end of 2015. Now, even though that the S&Ps and the stock markets has popped back up and regained most of the losses, treasuries have not, and Fed funds have not. So there appears, based on what the market is telling us, to be some damage where people are a little bit more worried and think, well, the Fed's going to wait to the end of 2015. I would still, target mid to third quarter 2015, especially if the economic numbers keep on looking good. This has been Dan Collins for Traders Exclusive. Looking forward to seeing what the Fed does later today.